Day Trading Radio presents a Briguy trading production.
Well, good evening, traders. This is Briguy with the Tools of the Trade show. And it's good to see all you guys out there joining us in the members chat room and anybody else who might be tuning in for tonight's show. As we previewed, we're going to be talking tonight about the new mini options that have come out as of this Monday, the 18th of March. And we'll talk a little bit about what the new mini options are and how they relate to some of the standard options. And we'll also talk about some possible strategies with mini options. And in particular, I'm looking forward to having on a special guest, Dilafng, who is kind enough to help me out in talking about covered call strategies, a strategy that she uses from time to time, and one that we thought we'd talk about in regards to the new mini options. So if you're a new trader to options out there, then you might find some of the concepts we discussed to be a little foreign. I'm going to use some terminology that you might be unfamiliar with. We're going to do our best to keep things simple, explain things in an easy way, and try not to get too involved with everything there is to know about options, since we have had quite a bit covered on past shows, and there'll be another show tomorrow which will be about options. So we don't want to spend the day just discussing options on its own. But if you're a member here at daytradingradio.com, you can sign into the members forum, and you could find plenty of videos there in the after hours section about options and different strategies for trading options. So we hope you take advantage of that. So first of all, what are the mini options? These were initially talked about, or at least I shouldn't say initially talked about, but initially announced to some options traders last year, giving everyone a heads up that this was bound to happen. And they were still evaluating and discussing which stocks would have mini options. They obviously don't want to have mini options on every single stock that's out there. And the article that I thought I had open is no longer open. What happened to it? Let's get that open. So when options were first proposed, mini options anyway, they wanted to offer them on a certain criteria. So some of the criteria include having it on options with a great deal of liquidity. So obviously you don't want to just have it on these different stock options that have hardly anybody trading it. There are, of course, options on futures contracts, or even on some of the indices like the SPX. You can get options. And on an individual basis, they are quite a bit. And I'm trying to find another article that at the last minute I realized I forgot to queue up here. So bear with me for a second while I get that going in another screen. The different rules for this are having a stock with a minimum price of $100 or more. So this is meant to be on the bigger traded, or at least the bigger priced stocks. And there are quite a bit that have a price of over $100 that are hardly traded. For example, Berkshire Hathaway, the A shares, which are, last I checked, was something like $100,000 a share. I haven't looked at it recently. Maybe you guys have seen that. But the options, the mini options, are not right now approaching stocks like that. But we are looking at stocks that have a minimum price of $100, an average daily trading volume of 10,000 shares a day over the past 3 months. So that's kind of a commonality for even the stocks that we're looking at. And they could be regular stocks, and they could be just simple ETFs. That's another way. And I'm just getting some notes here. Somebody's not getting any audio. So let me just confirm that the audio is working fine. I guess the audio is okay, because Dilafng's telling me that Berkshire A closed around 152,000 a share. So that's just amazing. That, of course, if you don't already know, is a stock that Warren Buffett has just made it a rule that he's never going to split the stock. So as they've gotten more and more expensive, it's the same price. No splitting going on. So interesting little thing there. And thank you for giving me a heads up that you guys can hear. Let me just turn off my ringer there so you guys don't get blown out with the dings. So to start off, there's 5 stocks that are right now set up for mini options, and we're going to take a look at those. They include, well, let me ask the room, actually. I'll tell you what, let me throw that out to the room. Do you guys, just name one. Let's not have somebody name all 5 of them together, but maybe somebody can name one of the 5, and we'll see if we can get all 5 together. Dilafng says Google, and that's correct. Google is one of them. Trey5749 says Amazon, and that's also correct. So we have 3 more. Google and Amazon are 2 of the 5 that are currently trading with mini options. And getting some others coming in saying that's the first to hearing of them. And that's why we're having this show. We like to talk about new things. And being a member here at daytradingradio.com, we like to keep you abreast of new things that are going on so that you can take advantage of them. And in some cases, maybe before others are taking advantage, and be ahead of the curve. The sooner you build up your experience with these things, then when they become, when the attraction is there and they have more and more liquidity, you'll be a pro. Apple is the 3rd that was mentioned, and that is correct. I've seen some others come through, and currently those are not on the mini options availability. The other 2 are ETFs. One is GLD, that's correct. Trey getting 2 of them, and there's 1 left. So we've got Google, Apple, Amazon, GLD, and Sonny gets the last one, SPY. SPY. So those are the 5 current securities that have mini options. And there is, of course, talk of applying this functionality to other options. And some of the ones that this could include are things like MasterCard and Visa, Priceline, Chipotle Mexican Grill, Netflix, even Goldman Sachs might come into play. And then there's also the share, something like TLT, the Barclays 20-year Treasury Bond Fund. So these are all possibilities. But like I said, they have to be, well, they'd have to be ones that they set up to be it. It's not going to be because we're going to lobby for it, but they have to choose to do it that way. And for now, this is the way that it's being done with these 5 new ones. Now, let me read to you some of the bulletin here that's come out of the NASDAQ OMX. So they started trading on the 18th of March. So we'll be able to take a look today at some of the prices that came out. And here's a simple description of what mini options are. Mini options are new options classes that will carry a deliverable of 10 shares of an underlying security versus 100 shares with a standard option deliverable. The strike prices, as well as the bids and offers, will be at the same levels as standard options. So that's going to be a nice feature. You're going to have the same group of options on the same group of strikes for the regular options as the mini options. Mini options are separate options classes that will not be eligible for trading in 1 penny increments pursuant to the penny pilot program on the first day of mini options trading. Similar to other options classes, if the exchange files to include mini options in the penny pilot program, an updated notification will be circulated. Now this is an announcement kind of directed at the exchanges, so let's get a little more technical. But you might notice when you go to trade some options that they're in nickel increments, and you can't get them in penny increments unless they get down to be a certain low price. And that is the case with across the board on the mini options, is they're going to be in nickel increments. So right away you're going to create a spread of 5 cents, even if they were trading right on top of one another. But you won't get a penny spread. Usually your spreads are a little bit more than that anyway. So let me clear the screen here of our presentation. I hope you guys like the little quote there. The money remains the same. It's the pockets that change. So keep that in mind when you're trading. And what I'll do is, let's bring over the screen here, and just for sake of argument, let's do something other than Apple. Every article I read about mini options talked about Apple, being able to trade Apple. So much talk about Apple. It drives me a little nuts. And of course I'm seeing here on the mini options, they are trading in penny increments. So it's the same with the regular options. Once you get down to that lower price level, then it will be able to trigger into pennies. So Apple, for example, was still at nickel increments, being the high value that they were. So here's a couple of examples of mini options. And what I have on the screen, on the top is the option chain for April monthlies. Okay? And then down below, in the lower part of the screen, are the April minis. Okay, so you notice they both say 31 days to expiration, and they both have April 13, that's the month and the year. But here you'll notice the 100, the standard reference for regular options, and then in this section it says 10 and minis. So this is to alert you that this section is for the minis. They've done the same thing with weeklies and quarterlies. They have it highlighted in red in my platform. But you guys can look at your own platform and see how they differentiate it there. But what you're going to notice right off the bat with the same strike prices, let's see if I can click on, without placing an order here. If I click on the 157s on the call side, there's something you're going to notice. Now, right now I have these columns set up for the volume and the open interest. So first of all, you've got the open interest on the April monthlies, the 100 options, the standard options. You have 17,000 contracts of open interest. In the second section, you have the mini options, and there's 111 of open interest. So not a whole lot in comparison to the monthlies, but that's to be expected. They just started trading yesterday. And I see some traders talking in the room. Has anybody tried out these yet? And that's certainly up to you guys if you want to do that. But I'll tell you what, being that it's such a new instrument, unless you had a very specific, if you've got a lot of experience with trading and you have a very specific strategy to play that you feel the minis do you better than the monthlies, the standards I should say, my suggestion is to wait until there's some more liquidity built up with the minis. Now here's something right away I'll tell you. The monthly, I'm going to keep saying monthlies, it's not monthlies, the standards. The standard options, if you look at these April 157 calls, are trading at 198, 199 spread. Whereas the minis are trading at 197, 201 spread. Now here's the thing. They are the same product in the sense of the pricing. Okay? They're not going to display a tenth of a value. You're not going to see these listed as 20 cents and 19 cents, and then you have to multiply it by 100. Instead, if you're new to options, what you need to understand is these prices are multiplied by the number of shares that they represent. So a single standard option contract is good for 100 shares. So when you buy this at $1.99, you actually buy it for $199. You times it by 100. Versus the 10-cent ones, versus the minis, if you were to get the $2.01 one here, it'd be times 10. So it's going to cost you $20.10. So yes, right off the bat, you should understand that there's a little bit of extra price put into the minis. Now, why is that? Well, number one, they're new, so why not charge a little bit extra for something that's new? Because they can, as they say. Number two, they have less liquidity. So with less liquidity, the chances of getting out of your position are a little bit harder. So the person selling it to you is going to charge you a little bit more. But notice, even if you wanted to sell it, your selling price is cheaper. Here's 197 versus 198. Here's 245 versus 244. It's looks like it's slightly a penny less until you get up here to the 154 strike. This is the same. 360, 360. 430, 430. This one's 5. The standard is 505. So it looks like it's either exactly the same price or slightly less than the same price until you get back to here, the 150 contracts, which are 570 versus 665. That's a disparity. But of course, there's no open interest. So you'd have to actually get somebody to write you the contract here if you wanted to. Well, if you're going to sell it, then you could sell it. But it would be a much cheaper price at this point. You'd have to play the spread in order to get that. So I see some guys talking in the room about just checking them out, doing some credit butterflies, just probably trying to dip the toe into this strategy. And that's certainly a way to do it. It's going to cost you less, obviously. You're going to put out less money, $20 versus $200 to get into a single option anyway. But here's the real kicker that I noticed, and that is that the commissions are the same. You're not paying a tenth of the commission for trading new mini options. You are paying the same price for your options. So what does that mean? That means instead of being able to save money somehow, some way with your tickets, for example, if you buy 10 minis, and let's say you're paying $1 per contract, here you could see in this example, you're going to pay the same. You're going to pay $201 for 10 of these. But then if you're paying $1 a contract, you're going to pay $10 for 10 contracts. And then you'll pay another 10 when you go to sell it. Versus here, you could buy one option contract for $199 and pay $1 for that one contract. Pay that once. So I'm talking a little slow here because I'm reading the comments in the room. But these are things to keep in mind. So when you see something like this and they advertise it and they say, "Oh, we're making it easier for folks because look at the price of Apple." You know what? Let me bring up Google. Look at the price of Google contracts. If you wanted to buy an 815 contract, it's going to cost you $2,300. $2,320. Look at down here in the minis. It's only going to cost you $232. Well, yeah, but you know what they just did? They took all the people that weren't paying the $2,320, $2,300, $2,320 for one contract, and they're sucking in some new blood who would rather risk $232 to get into this trade. And so they're going to increase the number of traders to get into these that maybe weren't getting into them before, and they're going to increase their pockets. That's the beauty of it, increasing their pockets. And before you start blaming the exchanges, the mini options have no new fees added to them, according to this announcement here from March 22nd. This is beginning on Friday. The NASDAQ OMX will begin trading mini options on Friday, March 22. Mini options will be traded on the following symbols: Apple, Amazon, Gold, Google, and SPY. What are the fees associated with mini options? The mini options transaction fee for electronic trades are $0 across the board for the customer, the professional, the specialist, the broker-dealer. The transaction fee for floor traders and QCC, $0 across the board. However, routing fees for customers will be a penny a contract, in addition to the actual transaction fee assessed. Well, we just said zero transaction fee, so they're paying a penny a contract. If the away market pays a rebate, the routing fee will be nothing. Routing fees for all other participants will be 15 cents. The cancellation fee for each cancel electronic delivery professional AON order will continue to apply to mini options. And the following fees will also not apply to mini options: payment for order flow, QCC transaction fees and rebates, monthly firm fee cap. So not only the brokers making money, but the exchanges will also make money because they're still going to charge you a penny a contract. So interesting, to say the least. So that's the basics of these. Oh, I wanted to show you the Greeks. Let's do that next. I think I have a lot of data on this screen here. So starting with the left side, I'll show you we're looking at implied volatility. And then we've got 4 columns of Greeks: the delta, gamma, theta, and vega. Then we have the theoretical price, which is based upon the bid and the ask, the open interest and volume, and then of course the bid and the ask. Now what you can see from this is the implied volatility of the actual option is very close to one another, but not the same. This is your skew that's getting built in. Now Google here, these prices are pretty close to one another. Here's 2260 by 2320 versus 2270 by 2320. This is where the market makers are going to have to be a little bit more involved if the public is not generating the other side of the trade. Let's switch over to SPY so we can take a look at that. And And again, we'll highlight the 155s on both the monthlies and the minis. And here you can see the bid and ask. Again, you've got a lower bid price on the minis versus the standards, a lower bid price. And already I can see that they're anticipating folks that want to sell the contracts. They're going to keep that price slightly lower and keep the standards as being a little bit more attractive. The delta is the same. The rest of the Greeks look the same, which I would anticipate that to be the case, unless you get implied volatility to be very, very skewed from where it is now. But the biggest issue right now is the volatility in regards to the volume and the open interest. If we go out to, let me close April, and let's say we go out to December of 2015, which you can actually buy minis out that far, and let's compare the December 155s to one another. So there you've got the implied volatility is skewed just a little bit more, favoring the standards have a little bit more volatility than the minis do. And yet, again, the price of the mini, the bid, is much lower than the standards, and the ask of the minis is much higher than the standards. So a much wider spread is set up. Of course, if we look at volume and open interest, there's zero open interest and zero volume on the December 15 minis. Nothing going on. So that's going to explain the huge spread that's going on there. So that's the gist of that. Now, what I thought about in regards to trading these options, and I'm not saying I would do this right away. I would probably wait to let some of the volatility build up. Here I am switching over to Google, and I lost the. There are apparently no December 15s. Okay, that was only on SPY. So here's the May monthlies and minis. I should say standards and minis for Google. And like we said, if you wanted to purchase this, it's going to run you $2,850 for one contract of the standard, or $286 for one contract of the mini. And those are pretty standard pricing structures. But the next question is going to be, what kind of strategies can we do? And this is where I'm going to rely upon our special guest for tonight. And I see she's answering questions in the room, so she's already been a special guest to you guys by addressing your questions. But if she's ready, I'm going to give her a call, and we'll talk about additional strategies that are possible with these mini options, including getting into some covered calls. So let me get her account here. It's got a very cute avatar, and we'll see if she decides to answer. If I can break her away from answering all these questions you guys have.
Hello.
Hello, Dilafng. This is Briguy.
How's it going?
It's going good. It's going good.
Good.
I appreciate you keeping up with some of the members there. They had some questions, and you've been busy since the show started.
I guess.
I thought I'd give you a break and let you relax and walk around the block and not have you on like right at the very beginning.
Okay.
But anyway, so you're on now. And so what do you think? We've been talking about these mini options. Did you have any first impressions from them?
You know, I don't have any first impressions of them. I have a first impression of you, though. It seems like, it seems like you're really down on these things, and I'm not Sure. I mean, I understand what you're saying. I don't disagree, but I think anything that gives people more alternatives for how to trade these expensive underlyings, I think it's good. You talked a little bit about the difference in the bid and the ask on the regulars versus the minis, and yeah, there is some difference, but it's only a couple of cents. So, hey, if people can make money with these things, I think it's great.
Well, I appreciate the feedback, and I didn't want to give the impression that I was against trading them completely. I do carry somewhat of a speculative view whenever something like this happens, and the brokers come out with something new, and they tell you one thing, and to me, I kind of step back and I say, well, wait a minute, why are they coming out with this? Is it really for the reasons they're saying? Or
you're so cynical.
Cynical, maybe. I don't know what it is, but
there's nothing wrong with cynicism. I think it's a valid point, but
okay.
Some people might love these things, so I just don't want to diss them too quickly.
Okay, well then, just for the record, I'm not saying that you shouldn't trade these at all. What I am saying though is be aware of the volatility issue and be aware of the liquidity issue before you start trading these like you're trading the other options.
Right.
I would at least let a few weeks go by, let all the other guinea pigs get out of the way, and they're not going anywhere. They'll still be here when you guys are ready to start trading them. And I see some of the traders have already started putting some positions on. Hey, more power to you. That's fantastic.
Yeah, I'm looking at the open interest. It is pretty low so far.
Yeah. So,
based on the Google, it is anyway. That's the one I have open right now.
And I believe I have that on the screen too.
Yes, you do.
So from that standpoint alone, sure, you can go ahead and buy one, but then when you try to go sell it, if there's not a lot of volume going on, you might have to keep lowering your price and lowering your price and lowering your price. So you really won't be able to use the same mindset for trading the standard options until it builds up a little bit more activity.
Right.
We had some question in there about the binary options and how that works. I started to look into binary options, and I'm trying to work out an arrangement to even have a show on that in the future. But it's my understanding that binary options are straight up directional decision plays. You're going to choose a time frame and a strike, and you pay a certain value for that. And you could do that for an hour. You could do it for the day. You could do it for the week. It's not exactly like regular options that are expiring on the third Saturday of every month, but it's like a whole other animal, really. I would say the binary options. Do you have any experience with binary options?
I do not. I have looked at them just very briefly, and my understanding, and I'm not haven't looked into them enough for you to. I probably shouldn't even be answering, but my understanding is they're kind of a higher lower thing. You bet whether it's going to be higher than this number or than this number, and if they go to expiration, it's an all or nothing sort of a trade. So that's not something I'm really interested in doing.
Okay. And J-Dub's bringing up the single stock futures that they tried to come out with. So he sounds like he's on my side of it, that there's always some kind of underlying thing going on with why they do these things. But hey, if they create a strategy for you to take advantage of, then by all means. That's, as traders, we try to take advantage of whatever we can. We have all the news feeds and the Twitter feeds and the updates as best we can get them. We got the Mr. Land calling out the news, and we got the guy in the pit, Ben, who's telling us somebody stepped up to the pit and they look like they're about to give birth. So whatever edge we can get as traders, we take advantage of that, and maybe there's a way we could do that with these mini options.
I guess we'll see. Yeah.
So, without further ado, as they say, let's talk about covered calls with mini options. And what I'd like to do is in TOS they have this little analysis tab that I thought I would use, if that's all right.
Sure.
And maybe we can build ourselves a little strategy here of shares of Google versus the options. And I'm realizing I have a bunch of other trades in here, so we have to delete some of these. And let's minimize that. So did you have any structured trade that you had thought about doing? That I'll just go right ahead and plug that in, or no?
I did not.
Okay, so let's do some Google. Let's say instead of laying out 800K to get 100 shares, that we instead pick up. Oh, and I wonder if it'll even let me change the number. Yes, I guess I can. All right, so let's do 10. And my audio is coming through on your side. I don't know if you can tell that or not. But might need to mute something. So here's 10 shares of Google, costing us $8,000 instead of 800 grand. Or is it 80? It would be 80 grand, not 800 grand. 80 grand. So we're going to do 8 grand instead of 80 grand. And if we have Google trading at 812, what would be the call, the covered call that we should be focused on?
Well, that depends on your outlook for the stock and the expiration date of your option. I'm looking at the Google chart right now, and it looks to me like it's ready to go back up. It looks to me like we've had a pullback for several days, a nice retracement there, and it went up today on a little bit higher volume than it had yesterday. So I'd be looking for this thing to go up. Now, when you sell a call, what you're doing is promising that you're going to deliver these shares at the strike price of that call. So if you're going to promise to deliver your shares, you want to get the best price that you can, right? So if I'm looking at, what's the expiration? April is what, 3 weeks out? Is that about right? 3.5 weeks?
Yeah.
I would be looking at where I think this thing might be in 3.5 weeks, and I want to maximize my return on this as much as I can. So if I think it's going to go up to 840 in 3 weeks, then I might want to sell the $840 strike price call. I'm probably not going to get as much for that call as I would if I sold a lower strike price, but if that stock does go up to 840 or higher, and that call is exercised and they buy my stock away from me because I've sold the call, then I'm going to get $840 a share. So, you know, again, it depends on where you think it's going and when, which stock or strike price you want to sell.
Okay, so I'm looking at the prices here on the April minis, and what I find interesting is that the volume kind of trails off here until we actually hit 840, and then there's a volume of 41 today that occurred. So you must not be the only person thinking that along those lines. And in fact, let me expand this and get a couple extra strikes, and you'll notice that that's like an outlier, the 840, and the 855 is another outlier. But anyway,
right. The 840 is just below the previous high, which is about 844. So maybe that's why people are thinking it can easily get back up there.
All right. So let's say we were able to get a little more than the bid price, and let's call it 1260. And I think, let's say, so we have 1 and we have the 10, and we're going to click over to our risk profile, and this is what it looks like. So when you, as long as the stock price stays below 840 and change, it's going to be your break even is back down here, but the idea would be for the stock to close below 840.
Well, no. If it were me,
Yes, go ahead.
and everybody has there are different reasons to do covered calls. One reason you might want to do a covered call would be to lower your cost basis of your stock. If you do this right now, if you were just to go buy 10 shares of Google, you'd get it at the mid price, whatever that is, and hope that it goes up. If you sell a call against that, then what you're doing is you're keeping the premium for that call, and you're lowering your cost basis for that stock by that amount. So, if you want to keep the stock, then maybe you should sell a strike price higher than you think the stock will go. Typically, if a person is selling a covered call, it's because, one reason people sell a covered call is because not only do they want to drop their cost basis on their stock, but they want to get that return. Because not only are you selling, what you're selling when you do this partly is time premium. So you want to collect that time premium. And what a lot of people do when they sell a covered call is they actually want the stock to go above the strike price of the call that they sell. Because if the stock goes above that price, they know they're going to make that amount of money on the stock.
Okay, that's the part I get backwards.
Okay.
All right, that's why I have you on. So in this case, then, why wouldn't we do something more like an 820 call? I mean, it's going to be less money, right?
You will be...
it says more money.
When you say it will be more money, do you mean...
It's $20 instead of $16.
It will cost you more money to get into the trade? Is that what you mean?
No, it's a credit, so I'm taking in that money. Let me go back to the option chain.
Okay.
And let's use this as an income strategy.
Okay.
So I'm going to keep the stock, but I want to generate some monthly income.
Right.
So I'll be able to keep the stock as long as the strike that I pick is below or above the price of the stock.
You get to keep the stock if on expiration the price of the stock is below the price of the strike price of the call that you sell.
Okay. So in that case, from you just mentioned that getting back to 840 is within the realm of possibility. It would seem like getting back to 860 would be a little harder to do, correct?
That's correct.
Okay. That's the way I thought I was looking at it. So let's look at 860 then instead of 820. And now we have 690. So in this case it'll be, well, let me get the spread. 690 by 730. Let's make that 720. No. 710 would be more realistic. Right? Yes?
The mid. I usually use the mid, so whatever that is. 720 looks like it would be the mid.
On a 690 by 730? Alright, we'll do 720.
Right? Or, you're right, 615. Whatever, doesn't matter.
Okay. So
I'm a little fuzzy brain.
So
don't
710.
like my bad math.
Alright, no problem. So 710 is the price, and as far as I can tell, if the stock trades, let me see if I get rid of this stock on the chart. No, that doesn't do it. If the stock trades above 860, then this will get called away?
That's correct. They're going to pay you $860 a share for your 10 shares. Whether the stock is currently on the market for $8.60 or $8.98.
Okay, anywhere in that range.
Well, anything above $8.60, they will call your stock away for $8.60.
Okay. But if I want to do this as an income strategy, then I'm picking a strike that's way out of the possibility, at least I hope, And so I'm going to keep the $71 is what I'm saying.
Right.
So in this case, you can put $8,000 into the trade, buying the 10 shares of Google. It's going to cost you $8,119.80. And you then can bring in $71 for the month.
Right.
And that would be if at expiration Google's trading for less than $8.60.
Correct.
Okay. So now the question is, what's the return on investment?
Depends on where the stock closes. I mean, you can calculate the percentage of return you're getting just from the call, but obviously your total return is going to depend on the price of the underlying as well.
Okay.
Right.
Yeah, and I'm never good with return on investment anyway. It's about, did I make money or I didn't make money? But and short of actually having that calculator in front of me, the point is that, let's say you keep the 710, and then the following month you can then load up with a different strike and be able to set a premium that you'd want to keep for that as well.
Right.
Now, am I utilizing the covered calls in the way that you are familiar with?
Yes, there are all sorts of subtleties in there.
That's what I'm sensing.
Yeah, I mean, it really, again, it depends on your outlook for the stock. If I were to buy Google right here, I don't know that I would do a covered call. You know, I had this conversation with someone just a few days ago. I think it was when Joel and I were on last Wednesday. You know, when you do a covered call, you have to realize that you're limiting your reward. People want to go long on a stock and they want to have unlimited reward. If they buy Google at 8.11 and it goes to 9.11, they want to make $100 per share on that stock. If you sell a call and you sell the $860 call and the stock goes to 9.11, you're going to miss out on $50 worth of gain approximately, because you don't get to take advantage of that skyrocket. You know, everything from 860 to 911 is money that you didn't make because you sold the call. So when you sell a call, you're lowering your cost basis on your stock, but you're also limiting your upside. So that's something that you have to really keep in mind when you're doing a covered call. You have to know when you go in, okay, am I going to be comfortable selling my stock at this strike price or not? And if that's not something that you're comfortable with, then you shouldn't be selling the call. Does that make sense?
It does, because, and it's starting to become clear to me. So not every stock strategy, not every stock and options combination here for covered calls, not every stock would fit the bill to do this strategy. You'd have to first find a stock that follows certain rules and setups.
Right. I'm sorry, I was going to say, if there's another strategy you can do, if it's a good time, or we can talk about it later.
Well, let me just mention something I was reading here. I went back through my notes.
Okay.
Because I did attend a class at the Trader Show with somebody that talked about covered calls. And this is Alan Ellman. And I noticed Beauty Bubble mentioned one of his books earlier in the room. And he is he's somebody that has a lot of experience with covered calls, and I actually showed one of his spreadsheets on the previous show. But his strike price selection that he gives for stocks is, if you're going to get one that's in the money. Now, we took one that was out of the money. The out of the money one would be when you're extremely bullish and the market is favorable. you would take an out of the money strike. And at the money strike would be good when the technicals are also good and the market is positive. In the money strikes for when you're conservative, and use when signals are mixed and or the market is bearish and volatile. Does that sound about right?
That does, yeah.
Okay.
That actually fits in with what I was going to say, too. If you owned Google, for example, back on March 5th, right before it made that new high, see that gap there? I don't know if you can point that out on your screen, but it made a high of 844. If you owned Google back then and you were afraid that the stock was going to roll over, but you didn't want to lose your stock or you didn't want to miss out on some gains, what you could have done at that point was sell an at-the-money call, or you could even have sold a call that was a little bit in the money, and that would have given you that premium no matter what happened. And then if the stock then fell down below that strike price that you sold, you get to keep the premium on that call that you sold, plus you still get to have your stock for when it starts going up again.
Okay, let me see if I can show that by using the software here. They have this Think Back section, and I won't obviously be able to show minis because they didn't exist. But let's change the Think Back date to the 5th, Tuesday the 5th, and these would probably be the closing prices of the options. So let's say we would do, probably still would do April at that point, right?
Yes.
There were 45 days to expiration at that point.
Well, actually, March might have been better because it was only a few days out.
Okay. Well, the March monthlies had 10 days of expiration, and if you go at the money or slightly in the money, here's the difference between 910 and 1170. So let's say you were a little more conservative to be 910, or which way would you go to be more conservative?
You would sell a lower strike price to be more conservative.
So go more in the money is what I was even
right.
wrote that down here. All right, so let's do, let me delete this again. 835 would be more in the money, so let me delete the duplicates here. All right, so there's the price, 1110, or 1170 rather, and obviously you could bump that up if you get the mid price.
Right.
This looks like it even plugged it in for 1205, which I guess would be about the mid 835s. Okay, so there's the one example. In 10 days, Google obviously stayed above 835. Here's expiration, and if I can get this moving average bubble to get out of the way, I can actually see the stock price.
You said it stayed above 35. It actually fell below 835.
Yeah, I didn't notice where the expiration date was until I realized it. All right, so what would that have done to this call?
That call would have expired worthless.
It would have. Okay, that's what I meant. So as long as it dropped below 835.
Right, and you get to keep the premium.
And so in this case, it was for 100 shares, so this would have been $1,205, right?
Right.
So that's not bad for a week's worth of work.
Yeah, not bad at all.
Huh. And if you wanted to be a little, I guess you'd be more conservative by taking more time?
You mean if you wanted to sell April?
Well, there's also the following week's weeklies.
Right.
And then there's the quarterlies.
Yeah,
So,
when I'm selling puts or calls for any reason, be it a vertical spread or a naked put or a covered call, I usually like to sell as close as possible. I like to sell the front month or the front week.
okay. Well, if you went for the ones that expired at the end of the week, that would be really jumping in here. But still, you'd get $700 for, or close to $800 for a couple of days worth of work.
Yeah.
Well, I shouldn't say that, because in this case we'd have to look at the expiration, which would have been 3 days later, right?
Right, and if the stock closed above that strike price, then they would have called your stock away.
And it looks like it traded the close of $834.82.
How about that?
Is that the right date? March 11? No, it's not.
Let's see, the
March
8th.
8th. It would be March 8th. So March 8th closed at $831.52.
There you go. So you would have gotten to keep your stock and your premium.
Very nice. Very
and then
nice.
sell the next week out if you think the stock is still going down.
That's right. All right. And someday this is going to click.
It will.
I still feel like I'm not getting it. I don't want to.
What's not making sense to you?
I guess it's the directional about staying above or staying below and getting the strike above or strike below. I don't know why I'm having trouble with that. But sometimes I'm a little slower.
Yeah, I know the feeling. I'm pretty slow too.
And plus, when I'm talking live on the show like this, I don't want to hold everybody else up while I stop and write everything down. I think I just need to paper trade it a few times, and then I'll be able to see it happening.
There you go.
Day by day. I'm convinced that that's the way to do it.
It makes a difference if you actually trade it, yeah.
Yeah. All right. Well, let me go back to this risk profile. And this was the April. And maybe what I need to do is turn off the stock. I think that's where I got confused. Because when I had the stock checked off, the graph looks different. So now I just have the option checked off. And this is what I was expecting to see. This is what you described. As long as the stock stays below 860, then I'm going to keep the full $71. Isn't that right?
Right. What you're looking at with the other chart tells you your total return, though, including the gains on the stock if it does get called away from you. So I think the other picture it's a fuller picture is what it is.
Okay. What this is saying, if the stock price went over 860, or I guess technically it's the 860 plus the 710, then my maximum gain is $500 or $551, which sounds to me like 860 minus 811.98. I should just make this 812 to be even about it. So it's the 860 minus the 812. That's $48 plus the $710 credit.
Right.
And that's what gets you the $551 gain.
Right.
So again, selling the covered calls would lock in your maximum profit if the stock or the price of the stock does happen to just start flying off on you.
Right.
But you won't lose anything because you've got the covered call.
Right. Right. It limits, when you sell a covered call, it limits your reward. I think that irritates people. In which case, they shouldn't be trading covered calls.
Well, yeah, I mean, that seems to be the point here. If you're bullish on the stock, then stay in the stock. The idea of the covered call strategy would be for, and again, if you're bullish on the stock, you should be picking a different strike price, right?
Right.
So,
yeah.
So that's
your degree of bullishness will determine which strike you sell.
Right. All right. So while we're discussing this, let me just throw this out to the room. I see the guys started getting into some other conversations here. Investor seems like he's happy with some news about his place in Florida. But besides going into that, if you guys had any questions about the mini options that you'd like us to talk about or take a look at, let me know. If you've got any questions about the covered call issues that we were talking about, you're welcome to ask about that as well. Otherwise, I don't have much else to share unless you've got something else that you started to talk about, Dyla. Did I cut you off?
No, I think I'm good. I know there were a couple questions in the room about implied volatility. I don't know if you want to speak to those now, or if you want to, I can answer those in the room if you don't want to go over it.
I think those questions came up yesterday too when we had Joel on. The fact is that volatility is not a number. Like, to me, I can say to you, if you're going to trade options, and this is just the strategies that I learned, then if you're looking at the Greeks, that you want to have a Greek over 40. That's just a straight up rule that I have. And then
which Greek?
This is the delta. Thank you. This is the delta. So I want a delta over 40, and I also I don't want to go more than 2 strikes out of the money. So here in Google, for example, I would be looking, I see the 40s continue on here. You got 49, 46. All of these are out of the money, 43, 40. But to me, I wouldn't go all the way out to 40, 4 strikes out, because it's not just $1 per strike, it's $5 per strike. So I would prefer to stay closer to the in the money price, or at the money price, I should say, and I would be more inclined to get, let's say, an 820 call before I would look at an 830 call. Secondly is I would rather buy one at the money call or in the money call versus 2 out of the money calls. It's going to cost me, in some cases it's about the same amount of money, but because of the deltas and the potential for movement of the price of the option, then, like in this example, I'd rather grab one 805 call, going to cost me $2,800, versus trying to get 2 835s out here. Same $2,800, right? But the delta of 36 versus the delta of 56 means that these out of the money calls have to move a lot more, or I should say the price of the underlying has to move a lot more to get these to move up in price. And I feel like I'm going to get a bigger bang for my buck by investing in a more in the money option. I don't know if you had any comments about that, Dyla.
Yeah, I'm with you. I usually, if I'm going to take a directional trade, which I've sworn off of doing, I would buy a strike price that has a delta of 80 or 85, just because I like the lower risk that's associated with that higher delta.
Sure. And there's other traders in the options rooms. They're going to tell you 60 is a number that they look at. So this is where you're going to find all kinds of information out there and all kinds of trading strategies. And I'm not the kind of person to tell you that one is better than the other, because if they make money, who cares how they're making the money?
Right. Yeah, it's all a personal decision. You know, I've said this on the air with Joel before. If you're great at making directional trades, heck, trade out of the money. Your leverage is higher. Yep. If you suck at it like I do, then, well...
You learn your lesson and you make adjustments.
Yeah.
Another strategy is what's called delta neutral trading. And so here you have the delta here is 0.49, and if you were to do a vertical, then you're going to be selling the higher strike, so it's 46, let's say, and therefore you're creating a delta of 0.03, or 0.3. So it's a little closer to being a zero delta, in which case you're going to make money going up or down, right? I'm not saying that right at all.
You lost me.
That doesn't make any sense. Let me do this as a vertical here.
You know, delta neutral, that's a strategy I've learned. I haven't used it, but that's a fairly complicated thing to be able to try to explain in just a couple of minutes.
Yes, and I'm not going to do that. But I'll just say that there is another strategy, and I've seen folks talk about it on some webinars in regards to iron condors, for example, or something called an iron butterfly, which spread out a little bit further. And as the price of the underlying moves throughout the week, you can buy and sell parts of that trade to spread out your wings further, or close down the ones that are way out of the money and lock in your premium, etc., etc. But there's ways to do that, creating these delta neutral strategies.
Right.
I've seen that done with XPX options. So not even with SPYs, but actually just doing it straight up with SPX options, which at some point, who knows, they may have minis on those as well.
Yeah, we'll see how people accept these new minis. We'll see if they catch on.
Yeah. Now, Kumar posted earlier that he put on an iron. No, he didn't say iron. He said butterfly, a credit spread butterfly. So maybe, Kumar, you can fill us in as to how that trade progresses during the week or the month. I don't know how far out you bought this or sold this, I should say. But it'd be nice to follow up and see how that plays out.
Getting back to the original question, I wasn't actually looking at Greeks. I was looking at implied volatility, which is the IV.
Yes.
And it might have been Trey that asked the question. I can't remember now. It's so far up in the chat log. He was wanting to know, I think, what or how the IV impacts whether you want to be a buyer or a seller of options. And I know J-Dub brought that up as well. But as far as implied volatility goes, the way I learned it, I look at the range of the IV over the last, 2 or 3 months and see where it is within that range. The IV is going to differ for each stock. So you can't really apply a number to it and say, well, if your IV is, below 0.2, then you want to be a buyer, and if it's above 0.5, you want to be a seller. It's not that cut and dried. But you want to look at the range of IV for the given underlying that you're looking at. So in the case of Google, let's see, the IV low looks like it came around end of January, and it was 0.18. And the high IV was about 0.31. And that was back in January, earlier January. And right now the IV has been kind of climbing this slope. Right now it's back up to 0.26. But when I'm looking at IV, you want to be a buyer of options when the implied volatility is low. That's when you're going to get your best option prices. The option prices start to go up when your IV is at the top end of that range for the given underlying. So right now with the Google, just looking at the graph of the implied volatility, and Briguy, I don't know if you can bring that up or not, if you have it on. Yeah, there you have it down. It's at the very bottom there. Folks, you can look at it there. Right now it's been sloping up, and it's in the top half of its range. So I would say it would probably be a better time to sell options than to buy them. As far as covered calls go, of course, you're selling a call. So if you're selling, you want that IV to be high if possible. I don't know that it's as critical for a covered call, though, because, again, depending on your strategy. Are you wanting the call to be exercised, and are you wanting your stock to get called away, or are you hoping that the stock will go down and you'll get to keep the premium and the stock? So again, it's just a strategy evaluation. Hopefully that made some sense.
Yes, and actually I got caught up talking about the deltas that I forgot to circle back to the implied volatility. I was just trying to make the point that for a delta I can give you a number and say if it's higher or lower than this, but for an implied volatility, what you said.
Oh, good.
Just that it's not a number that you can.
Makes sense then.
Yeah, that it's not a number you can point at and say this is the number. but I could say this though, understanding volatility, if you're going to be an options trader, understanding volatility is a great resource to choosing the prices for your options, because you don't want to overpay on options. And there's times when the volatility is low. If you're the strategist of selling options and volatility is low, you might find that it's a little more risky to sell those options, or at least you're not going to make as much by selling those options. If you're a buyer of options, then you want the volatility to be low ahead of the anticipation of it moving far, and therefore increasing the volatility. And throwing on your chart, for example, this implied volatility graph gives you a chance to go back and figure out, well, what's going on. So, for example, look at earnings over here. So here's earnings, came out on October 18th, and the trade day of October 18th. So the day before earnings. Actually, if I remember correctly, I wonder if Google actually pre-announced for some reason. In fact, I have that note. Actually, there's a note on here. Looks like I was keeping myself alerted to that. Earnings were released midday. So when you're looking at this giant drop, that's what happened. So look at volatility. The days leading up to the earnings, here's volatility getting up into the 30, 31 percentile. And as soon as earnings are out, it drops. Now it's down to 24. And in the week after, it's as low as 21, 22, 23, somewhere in that range. So the events are what create the volatility. You get the same situation over on this earnings release. So look, you have the stock moving up higher after earnings, but the volatility got sucked dry after the earnings. So it's the run up to the events that creates the volatility. And of course, news will add to the volatility. If there's a merger acquisition, if there's a CEO stepping down, taking a medical leave, for example, or a giant lawsuit that happens, these are all moments of increased volatility that will increase the price of the options. So when you understand volatility, then you'll do better with your trades. Got a question coming in here. Why should the volatility drop with the increased price dislocation? The reason, zero in, is because the price is no longer a mystery at that point. When earnings are due to come out, then you don't know whether it's going to be good news or bad, so you don't know which way the price of the option is going to be. And remember, options are basically an insurance policy. So if the person writing the policy doesn't know what's going to happen, then they're going to have a higher premium. But once the earnings comes out, and now we all know what the news is, well, now it's going to be a much lower insurance policy. The price, anyway, will be a lower insurance policy. I always bring up the analogy of a hurricane. If you're going to buy hurricane insurance the week before hurricane season starts, when they've already forecast 3 of them coming up the Gulf of Mexico and 2 of them coming up the Northeast, then that policy is going to cost you a fortune. But if you're going to buy a hurricane policy in November, when the season's over, and there's nothing in the forecast, then it's going to be a cheaper policy. This is month by month. And yeah, there's a little bit of echo because Dyla got tired of listening to me through her headset, I guess. I don't know. I don't know why we get that echo either.
I don't think so.
I hear myself coming back on the speakers.
Oh, do you?
Yeah, I don't know how that is.
I don't know. I have you muted on the DTR site.
Oh, okay.
You could hang up on me. That would do it.
Oh, no, we're not going to do that immediately. We'll do that in a little bit. And Kumar's right, too. Insider info is something that's going to help that one way or the other. I hear you clicking, Dyla, so is there any other questions that you were able to mine over there? Pun
You know,
intended.
I've missed most of the chat. So if anyone has any questions that we missed that apply to the covered call discussion, then if you could retype them in, that would be great. But I think we've covered it.
RCNet's asking about covered calls before or after earnings. Now, again, I'm not the experienced one here, but on my notes for that class I went to, they said absolutely avoid earnings reports.
You know, in the case of a stock that you really like and you want to hold it and you want to hold it through earnings, but you're not sure what's going to happen with the earnings, I actually did this with Bloomin' Brands, BLMN. I did it before the last earnings call. What you can do is you can actually sell a call that's in the money if you want to protect yourself in the event of a sudden drop after earnings. What you're doing there is you're just the way that you are limiting your reward on selling an out of the money call. What you're doing when you sell an in the money call is you are assuring that you're going to get any run up that that's already taken place. And you know, that's what I was mentioning previously about this Google trade. If you have a big run up and you don't want to miss out on that, you want to lock in some of those gains, you can sell an in the money call, and then if the stock goes down on earnings or on news, then at least you get to keep that premium on the call that you sold. So even if the stock does drop after earnings and it goes back down, you got to make money on the increase that happened before the earnings call.
And in that case, if the stock does move down past your strike price and further, then you could wait for the dust to settle, and if you still feel good about the stock, you can buy it at that lower price.
Right.
And then the cycle will start all over again.
Right. So I hope that answered the question, RCNet.
And remember, too, the way you phrase that question is you're selling the call. That's the strategy of a covered call. You're selling the call, and later you can either let it expire worthless, or if you choose to, you could buy it back. You know, if it were to if the stock went and dropped in value the next day after you went and sold that call, and the call's worth, you know, a tenth of what you paid for it, you might consider buying it back for such a low price. You'd lock in your gains that way. And maybe something really weird happened with the stock, but that's something that you can always do. Don't if you're new to options, something that a lot of people forget is they think that once they bought or sold it that they have to wait until expiration, and that's not the case. You can always close the trade sooner.
Right. So the way he's worded the question, does that mean you should buy covered call after earnings but sell before earnings? A lot of times folks will refer to a covered call as a trade that you do after you already own the stock. In the case that you are buying the stock and selling the call at the same time, some folks call that a buy right or a covered right. So you want to be careful too when you're speaking about these things to get the language correct. Briguy, I think you just said a couple minutes ago that if you bought a covered call, you could buy it back later for less if it dropped after the earnings. What you meant, of course, was if you sell the covered call before earnings.
Thank you.
Yeah.
And I just meant the next day. I don't mean around
Right,
any kind
right.
of specific event.
Right.
But just in any time frame, especially if it's a credit, if you, like an example we looked at, sold that one Google option for $710, or I should say $71 because it was a tenth, and you did it for $71, and the next day something happened, and because of that the option was only worth $10, then you might consider buying it for $10, and then you'd make $61 on the trade.
Right.
Instead of risking the rest of that time to still be able to get the extra $10. If you follow what I'm saying there.
Yep, I think that made sense.
Okay. Well, in that case, okay, now I'm seeing another question come in. And Coder's got another strategy. So, Dyla, I'll give you a choice if you'd like to stick around, or if you'd like to, I could thank you for being on. And Coder's got some questions you'd like to Skype in with.
I'm kind of curious about this wild-ass option strategy.
Okay. So, Coder, yeah, absolutely, you can call in. I don't know if you're in my Skype profile. We may not have talked before. But
he's even asking me to stay on. Thanks, Coder.
Oh, isn't that nice?
I feel wanted.
Excellent. So then, yep, Coder, go ahead and call in, and I'm going to figure out why my laptop is not logged into the chat room properly.
Coder's great. I haven't seen him in a while, but he has been doing these evaluations, I know, and he came on, I can't remember if it was with Johnny or whom, but he does these great evaluations and looks at all sorts of things and does a lot of homework, and then is good enough to share it with us. So I'm always happy to hear whenever he comes on.
Okay.
J-Dub apparently wanted Kumar to call in too. Kumar had a butterfly, I think. A GLD butterfly.
All right, Coder, where'd you go?
He said he needed a few minutes to set up. I wonder how many it is. Can we ramble for a few minutes?
We could. And now I'm going to give you an echo of your voice as I'm trying to get my other machine logged in here. What do we got here from Zero In financial mathematics, the implied volatility of an option contract. I'm going to get a headache reading that definition. RCNet is asking about how you play options. And
oh my gosh. How do you play options?
Is it as a premium income, or directional, or spreads, or all the above? Oh, you know what I did, Kumar? Hang on a second. I answered Kumar and put Dyla on hold, and that's not what I meant to do. So let me...
I can hear her somewhere.
Yeah, I just realized that. Let me, let's see, add people to this call. And they updated the software here. And here, add to call. Okay, that should have fixed that. So I should now have Dilafng and Kumar on the line.
Hey, Kumar.
Hey. My audio settings. Okay, my microphone seems to be okay. It's the right one. I have 3 microphones here, so I don't know which one is working. You know, it's kind of sometimes very confusing.
You sound good from here.
Oh, thank you. The first thing is somebody was talking about whether I had sold gold or GLD. So I do have butterfly in gold, and it's sort of gone beyond my price, but I don't care. In effect, I have a butterfly centered around. It's a call butterfly, bought call butterfly at, I think 154 or 152 is the body value. The wings are 2 strikes away.
Okay.
What I typically do in that kind of a butterfly is I buy it for net credit. I just tweak it a little bit so that I buy it for net credit.
Mm-hmm.
Which takes care of a little bit of the commission also. You know, even if I get 4 or 5 cent credit there, that's okay. That's good enough. And then I don't really have to worry about it. If it pins in the body of the butterfly, great, I make money. If it goes elsewhere, 0, infinity, I don't care. because my risk is already there. I've got 4 cents or 5 cents credit, and so one of the trades I do and forget about it, and then look it up around the week of the expiration. Where is it trading? For example, GLD is now currently today it was trading around 155, and if my butterfly body is 152, I don't really have to look at it. I'll wait till April. It's an April thing, and see what happens in OPEX in April. Hopefully it will come down because I have no risk in it.
But if you're getting 4 or 5 cents, is it really worth doing it for 4 or 5 cents?
No. If it pins at the strike, then I get a couple of $100.
Okay. So it's more than
because
just the
the
4 or
time
5 cents.
value and the intrinsic on both sides decays. So if I have 150, 152, 154 butterfly, they all have an extrinsic value and time value and whatever the hell they are called. I don't know. These options are so screwy. But if my body is, so I buy one, let's see, I buy one of 150, I buy one of 154, and I sell 2 of 152. So if the price is around 152, both of those would have, one would be fully in the money, one will be totally out of the money. The time would have value would have gone away, and it leaves you with some nice bit of money without having to lose anything.
Yeah, butterflies are a bit more complicated than your basic covered call, wouldn't you say, Kumar?
Well, life is complicated, but, I'm just saying, because somebody asked, I'm just saying it that because somebody asked a question.
Right.
So I tend to do butterflies, particularly if I get a credit. I will do a butterfly for a credit. Then I'm happy, because then I don't lose anything. It's not worth it if it, doesn't produce any money, but at least I don't lose any money.
Good point. And in that case, though, you would still, you'd have to lock up some funds, I'm assuming, to hold that position, right?
Yeah, a spread, basically a spread, single spread. So that's okay.
All right.
If you look at a GLD, which trades in $1 strikes, and if I do 150, 152 kind of thing, so, it's just one spread, so.
Yeah. All right, let me ask you guys, Coder has finally added me in Skype here, and he's ready to call in. Do you mind him being on the line as well? Or do you
I
have
will
something to
retire.
finish up? Okay.
Should I disconnect?
You could stay on, Kumar. I just didn't know if you had more to share on that trade.
Well, on this one, this is because somebody made a comment. I always have plenty to say. I like to talk just like you, but that's okay.
Okay, no, not a problem at all. So let me see if I can do this on the new software here. I'm going to try to add Coder.
I'm happy to withdraw. I will disconnect myself.
That's good. I'll leave it up to you.
No, stay on.
There you go. So welcome, Coder, to Briguy's Tools of the Trade. Thanks.
Oh, let me mute the sound here. I think I got an echo.
And I see you're a fellow East Coaster.
There we go. Yeah, I saw that too. You're in New Jersey?
Yes, I am.
Oh my God, what exit?
Exit 10.
Oh, exit 10. That's not too far. It's about an hour. I'm exit 4.
Right. Yeah, I've been to some doctor's visits down in that neck of the woods. So.
Oh, I've had some customers up in yours. That's great. Well, maybe we'll get together one day.
Sounds good. So
I need to go real slow with this.
Okay.
Okay, and I have a little chart on my screen. I hardly ever use Skype, but when I called in to Johnny before, and I was able to share my screen somehow. There's a button somewhere on Skype.
There is, and what I have to figure out is how to do it for a group call.
Screen options for this call. I think it was on my end. Sorry, let me just look real quick. Call. It's right on here. Oh, here it is. Share screens. Okay.
Yeah, I think I have to do it on my end in order to get your screen, but I don't know if all three of you got the request to share your screen. I don't know. Let me see here. Now it says I need Skype Premium to share screens. I never did that
sorry.
before.
All right, never mind.
You can only share one screen, so he can share his screen with you.
Yeah.
Only one screen.
I'm
You
just
can't
trying
be
to
sharing
find
two.
the option for that, because when I click on... yeah, I only get the option to share all the screens.
Briguy, is there
You
a
have to
way
pay money for
send
that.
you a file?
You want to send me a file? You can do that in Skype.
Yeah, and where do I do
Go
that?
back to the place where we were typing before.
Share his screen, for heaven's sake.
Yeah, they don't let me do that with group chat or conference calling.
Oh, I see.
I would have to hang up on you and dial it in order to do that.
Oh, I see. Okay, you can hang up on me. I'm happy to go.
And if he's just sharing a picture, then he could just...
He doesn't have Jing.
Yeah, that too.
He needs to get Jing.
Coder, do you see where it says send file? It's a little plus sign.
No, I'm sorry. I'm trying to get back to the chat.
Yeah.
Briguy.
Or just hit the plus sign. I think somewhere in there gives you the option to send a file. You might end up sending it to all of us, but...
Oh, here we go. Okay, send file. Okay, I'm getting there. Let me just find the file. Is this one real? Okay, here we go. This is it. Open. Okay, I think I'm sending it.
Okay, I'm not seeing anything on my end just yet. Oh, there it is. Save as. It might contain viruses. Oh, no.
No, it's just a picture.
Yeah, they're just warning me for everything. Just waiting for it to finish downloading.
Wow, I didn't think it was that big of a file.
I think it's just my computer. All right, now it finally lets me give it a name. So let's put that in this folder here. Oh boy.
Well, while you're doing that, I can start to explain it, and then if you get the picture, that'll help illustrate one of the key concepts of this strategy. So what this is, I had one of those experiences where I saw a move coming. It looked like it was going to be a big move, and I put my stop way out of the way. So I figured where I would normally put my stop, and I figured this is where most people are going to put their stop, and I put my stop 3 times that distance away, okay? And then here comes the move against me, goes up, hits my stop exactly, and then turns around and goes the other way and made the big move that I had anticipated, but of course I was stopped out. I know that happens to everybody, but this was just ridiculous because I moved the stop 3 times, where a reasonable stop should be, and it still seeked me out like a heat-seeking missile and took me out. I'm not paranoid. I don't think that we're looking for my stop. There just must be a whole bunch of other people that also decided to put their stop at 3 times a reasonable location.
No, you're naive. They were looking for you.
If they're in New Jersey also, I wouldn't be surprised.
Forget about
it. That night, I literally couldn't sleep. I stayed up in bed, and I just kept thinking, what can I do? What can I do to get out of this? Because obviously you can't move your stop too far away. You could move your stop too close, very close, and if you get stopped out, just wait for it to penetrate you, reverse after taking everybody else out, and go back the other way and just get back in. But I didn't really want to. I was looking for a better way. So about 3 in the morning, a light bulb went off, and I jumped out of bed and got some paper, and I wrote it up, and then the next day I wrote it up some more and thought about it and set up some paper trading, and sometimes it works and sometimes it doesn't. But so here's what it is, okay? So the basic idea is to buy a number of shares of stock equal to the delta of your option. Okay, and it doesn't really matter if it's a call or a put. And what you want is you want a stock that is volatile, very volatile stock. You know, the more it moves, the better. That's really what you want. Something like Apple.
Okay.
Right.
And what's the strategy you're talking about here?
I'm getting there.
Okay.
All right. So the idea behind the strategy is how can you trade a volatile stock with taking very little risk, right? Because I had just gotten stopped out. So here's the idea: you buy a stock, or you could short a stock, but let's just talk about this one case, right? So you buy a stock, and you buy a put, okay? Or you could short a stock and buy a call. It doesn't matter. You could go either way. But to kind of make it easier to
pick one.
Yeah, okay. So I'm going to pick going long on the stock. So I'm going to buy some stock, and I'm going to buy a put option to protect myself, okay?
Okay.
But what I'm going to that option, of course, controls 100 shares of stock. But I'm not going to buy 100 shares of stock. I'm going to buy the number of shares of stock equal to the delta of the option. Now, I thought about it, and I figured out that a 50 delta, or as close as you can get to 50 delta, is actually your optimum. So I'm going to just talk about a 50 delta. So what I would do is I would buy 50 shares of whatever, let's say Apple. So I'm going to buy 50 shares of Apple, and I'm going to buy one put option, right? And you can do that in units. You can buy as many sets of these as you want. All right, now watch what happens. Let's say that let's say that Apple goes up $1. Okay, so Apple goes up $1, and you have 50 shares, so you're $50 up. Now, what happens to your put option? Your put option has 50% delta, so your option is going to go down in value because it's a put and the stock's moving up. How far is it going to go down? Well, the stock moved up $1. Your option's got 50% delta, so your option's going to go down $50. Right? Well, 50 cents times 100. So you have a $50 gain in the stock and a $50 loss in your put, so you're even. Not counting commissions and slippage and bid-ask spread. So now let's say that it loses $1 from where you bought it. So you go long 50 shares, you buy your put option, and now Apple goes down $1. Okay, what happens? Well, your put option increased in value. How much did it increase? Well, it's 50% delta, so 50% of that $1 is 50 cents times 100. You're $50 up on your put. Now, what happened to your stock? You had 50 shares of stock, went down $1, so you're down $50 on the stock. Look at that. You're still even. Okay, now you would say, so, Coder, why would you put this on? This is ridiculous. All you're going to do is break even. Well, if you stay near where you entered, if the price stays near where you entered, that's exactly what's going to happen, but you're not going to take a loss. You're going to break even, right? You will take a little bit of a loss because of, like I said, commissions and stuff, bid-ask spread. But now take a look at the chart that you have. What you'll see is that the further out the option expiration date, the less the slope, okay, the more shallow the slope. And the closer to expiration, the more steep the slope. Now, what you're looking at is, on the y-axis there is your delta, okay? And going across to the right is your stock price. So what that's telling you is that the further that the price moves, your delta is going to change. Or let me just say that differently. As the price moves from where you entered, your delta changes. So you start out at 50%, but as you start to get into the money of your option, whichever option you get, as you start to get into the money, your delta is going to start to increase. Okay, it won't be 50% anymore. It's going to go to 55, 60, 70, 90, right, and keep going up. As you go down, or as it goes away from you, as your stock goes against you in terms of your option, your delta starts to decrease. So it'll start out at that 50%, but as your option starts to get out of the money, it's going to go down to only 40% delta, and then 30% delta, and it's going to go down. Now, you'll see it's kind of like an S-curve, that there's a steepness there, and then it starts to trail off. All right, but here's the idea. Because you got a volatile stock, you expect that stock price to move significantly. So let's go back to the example where I'm long 50 shares and I'm long a put. Okay, one put, and let's say the stock's going up now. So what's going to happen as the stock keeps going up? Let's say it goes way up. Well, because that price is moving against my option, that delta is going to go down in value. So that, plus and minus isn't going to be even anymore. You're going to start to lose less money in your option than you're making in your stock. Your stock's always 1 for 1, of course. So in the beginning, when it's right near the price that you entered, your option is losing half the stock move, that 50% delta. But as that stock's rising, now you're only going to lose 40% of that stock move, and then you're only going to lose 30% of that stock move. But your stock is gaining 1 to 1. Okay, so you're getting a divergence there. You're opening up this gap, and that's profit because you're making more money in the stock than you're losing in the option. Okay, and the reverse is true. So as that stock's going down, well, now your put option delta is starting to increase, right? It's going from 50% to 60%, but your stock value is losing value. It's still 1 to 1. So, the further that the price moves, in the direction of your option, as in this example, as that price is dropping, your delta is starting to swell. You're getting your 90%. The stock's moving so much. So now you're gaining value in your option faster than you're losing value in your stock. So the whole idea of this is, if that stock doesn't move much, well, you pretty much break even or lose a little. But if that stock shoots up or shoots down, you'll make money. So theoretically, I can't figure out any problem with this strategy. I also tried to see if anybody else thought of this. I'm sure I'm not the first one to think of it, but I've never heard of this anywhere else.
Well, I hear Dyla has turned back her microphone on, so maybe she's got a comment here.
Yeah, I wasn't sure if that was me causing the echo, so I muted myself, and I apologize if I was echoing. A couple of things. I think it's a great idea. You're talking about, it sounds like just doing a delta hedging sort of thing. My concerns would be, first of all, you have to be really good at the timing on this. If you're good at directional trading and you know when to get in, when to get out, then this is great. The other thing you mentioned, Coder, you said that you won't lose much if the stock stays still. On a 50 delta put, in this case, you're going to lose your time premium. So that is going to erode a little bit as you approach expiration.
Be in this for a very short time, like...
Well, then you'd have to take a look at the theta value on that stock, on that option. And instead of doing a weekly, it sounds like you want to be looking at a monthly.
You know what? Don't be misdirected by this chart. This is just a chart that I found. I'm not trading in these time frames that you see on this chart. I'm literally just trading for a minute. 10 move to last, but this is for short-term trade. Theta, unless it's Friday afternoon on a weekly, it is going to affect you that much. It's a balance, of course. The less time you have to expiration, the steeper that delta curve that's showing in that chart, and that's what you want. You want as steep a delta curve as possible. But on the other hand, of course, you're right. The theta is going to be higher. The higher the theta, the steeper that curve. You're going to be losing time value. So you have to try to find a balance. And I'm thinking Apple Weekly on a Thursday would be something like an optimal, way to do it. But I saw Epik. I'm not good at reading the chat room as I'm thinking and talking and whatever, but I think I saw Epik say that the banks do this all day long. So I'd love to hear more about this. Like I said, I'm sure I'm not the first one to think about this.
May I make a quick observation here?
Absolutely.
There is something called gamma scalping. Okay, we know what delta is. Delta is the first derivative and gamma is the second derivative. And gamma in that sense is the derivative of delta.
Right.
And the closer you get to the price, as delta changes, gamma starts moving faster and really gets you. That's what happens to the option premium. When you are short or long an option, you can see the price, how it you think you are short and the price is approaching, and it gets faster and faster and faster. You get into trouble as you get deeper into the money, and that's called the gamma effect. What Coder is saying as an example of that, let's say I thought Whole Foods was going nowhere. It's going to be at 100 and it's going to be around 100 forever. So I don't buy the stock. Coder started by saying you buy a little stock, you buy a put, but you buy the stock equal to the amount of the put, which is kind of making yourself delta neutral. So what I do in a Whole Food situation, I sell a straddle, a 100 straddle. I sell a call and a put. Now it can't go both ways. My assumption is that by expiration, it's just going to be around 100 and I will make money on that. Now along the way, what happens is it either goes up or it goes down. So to neutralize my delta effect, I either buy as many shares or I sell as many shares depending on which direction it has got moved. So I start with a kind of, let's say, a certain delta, and to keep that delta at that level, as the price moves up or down, I either buy the shares or sell as many shares to keep my delta at the same place. And you have to do that constantly, and it is what is they technically call it gamma scalping. As the gamma changes, you just want to make sure you don't get a gamma burn. It's also called as a gamma knife edge. So you just want to buy and sell stock. Now the problem with that strategy, it works most of the time, but as long as you are buying the stock, that's okay. You want to buy 20 shares or 10 shares or 13 shares of anything, that's okay. But when it comes to selling the shares or shorting the shares, and the US tells you, oh, sorry, no shares available. So then it does not work. That's a bit of an issue there. But it's a very complex strategy, and I think left to very, very people who are kind of, well into it, understand what they are doing. And it requires your ability to buy shares, which I'm sure everybody has, but also short shares. And if you cannot short the shares, you cannot do gamma scalping at all in that sense.
Right. Well, Kumar, it sounds like that would be a strategy if you want to stay neutral, right? So, but this strategy is kind of the opposite. It's that I want there to be a difference between the delta. I want that delta to change as much as possible, right? To open up that profit gap.
Right. What he's trying to do is you're hedging your deltas. That's all you're doing. When the market moves, you're going to gain exposure. So you have those puts on, and when you're buying puts, you're buying the underlying. So that'll make you long. Well, at the money,
when you're buying puts, you're not long. You are short.
No, but I'm also buying the underlying. If you buy puts, you buy the underlying. You're hedged. Now, if we move higher, my put delta is going to get smaller, and I'm going to get longer the underlying. And as that market keeps on moving away from the at the money, getting longer and longer, the stock, my delta is going to get longer and longer. Because when you own puts, you're negative delta. And when you're long the underlying, you're long. So as
no, I understand that. But what about the other side of it where you have to short I'm sure, I do get what you are saying.
So
but
as it moves, you can keep on shorting into your delta. And that's how that's what we do. We'll scalp around that.
No, but if you don't have the ability to short the stock, then how does it work?
In futures, if I can't short the underlying, then I can't do it. But
that was what I was trying to. I mean, I really get what you are saying, and there may be a different variation and strategy of that. But I was just trying to say
when you do the straddle trades. The straddle is a delta neutral trade, and when you look at gamma to understand what your delta is going to do, so you know how to hedge your straddle.
Well, I would have actually done a strangle, but I just mentioned straddle for simplicity here.
The strangle is going to have a delta, whereas
there will be a delta,
but the straddle is not.
I just wanted to point out the difficulty of this kind of I'm sure I will have to think more about it and whether there is another way to do it. My difficulty has been the inability to short the stock. As long as you're buying the stock, it's okay on one side, but if you can't short the stock on the other side, then you're only doing one side.
I mean, in the futures market, it's easier to do because you can short the futures whenever you want.
Yeah, but we're talking about equities here. That's a different animal.
Okay. Well, you got to make sure you need a highly liquid stock that you can short, that you can borrow against.
Hey, I just got a call from my broker last week that hey, IW can't short IWM. How much more liquid can you get?
Really, IWM you can't short? I used to arbitrage IWM.
Well, my broker said, sorry, you are short IWM. We can't, can't do that.
Because they want to screw you. They obviously can't borrow it. And IWM is an exchange-traded fund.
Exactly, and there should be an issue there.
Doesn't want people to go in and sell it.
I mean, think about what is going to happen to Dilafng if she's short stock and the broker calls her and says that you can't be short IWM, you can't borrow IWM, Right. It's not easy. I just wanted to make that point. But whatever you said is right. I just wanted to make the point, and I brought in this gamma scalping thing just to illustrate the difficulty, because you need the ability to buy the stock, which is not a problem. But at the same time, you need to have the ability to short the stock. And if you can't short the stock, then things doesn't work.
Exactly. Well, and when you're dealing with stocks and if you have to borrow it, then you have problems. Two is also if you're looking at gamma, you're looking at gamma because you're holding on a position. If you're going to trade a stock trade the option for a day or two, why am I going to be looking at the gamma? It really is not going to affect it, or the theta.
No, I'm not looking for a day or a two.
For direction, making the move, and getting out. But what happens with a lot of young option guys, they're like, oh, I'll give it another 2 days. Oh, I'll give it another week. And they don't understand how fast that premium will decay on you and things like that. That's one of the biggest problems about young options traders is they're like, oh, I was only supposed to be in it for 2 days, but it didn't turn out, and they end up staying in it for longer, and that only goes up. All of a sudden, they look at the options price, and they're like, well, it's going to cost more for me the transaction cost is more than what it's worth, and so they let it go worthless.
No, I was looking at that trade from a longer perspective to get the theta and the extrinsic, get the benefit of that. If I did a strangle, if the mean price of WFM is 100, and if I sold 110 and 90, strangle, I'm going to wait, and I'm going to manage that by shorting the stock.
Right. Plus, you have to have, your clearing firm or your who you do your stock transactions through, you have to have the highest clearance to be able to short stuff and to be able to short the options or to trade it like you supposedly supposed to trade it.
No, all that I can do, but I can't unfortunately always find the stock to short. That's my difficulty.
Oh, okay.
That's otherwise I don't have the. I mean, I am short. I mean, I'm get assigned stock.
I'm only 5'7".
I mean, the Dilafng has a problem. I do short calls all the time. I just go to bed and short SPY and go to bed kind of thing. Makes me feel happy kind of thing. But anyway, thanks. It's interesting. But I'll have another look at it. See how it
It's just like, Coder, all you're trying to do is basically delta hedging. So when you put on your trade, you're basically got a delta neutral trade. So you're waiting for it to move, and when it moves, then you can either sell the stock against it, cover it, or whatever.
Right. Well, you're exactly right. What I want to do is I want to get in. I want to be neutral so that in case I'm wrong about direction, which happens a lot, I won't take as much of a loss, right? But if it starts to move, even if it moves against me, right? Like let's say I think it's going to go up, and it starts to go up, and then it turns around and just drops out and goes the other way. Well, with this strategy, if I don't do anything, don't add any stock, just let it go, that profit window is going to start to open up, right, as the delta's changing on that option. And then if it hits some likely place to get out, some level of resistance or a pivot or whatever, then get out and I'll capture the profits. So theoretically, it should work, right?
Yeah, but you have to be diligent and you have to know, basically what you're talking about is your break even. So when you put on your trade, you need to know where your break even is at and where you start making money and where you lose money.
Yeah, and I didn't see how you could calculate that, really. That's why I've just been paper trading it, and I'm trying to see if it behaves the way I think it will.
When you buy the put, let's say you bought it for $1, a $5 put, and you bought it for $1. Well, that put would have to trade all the way past 4 before you reach the break even.
Well, yeah, you start out behind the curve a little bit, but you're making money on the stock, right, on the underlying.
I mean, have you ever thought about a collar trade where you go buy the stock, you go sell the call, so you do a covered call and you take that premium and you buy the downside put on it. So where your break even's at and you start losing money, you're buying that put strike, so you start making money on the downside. And that a lot of people use that for longer term trades, where you're not going to, there's earning in 3 months, but you're putting on this collar for a longer period of time. It's for hedging purposes and to protect you from the downside.
Okay. Well, the one thing I noticed, I really, I thought this would work, and then one day I was paper trading Apple, and I was in with this strategy, based on another setup that I saw, and all of a sudden news came out. And Apple just took off, just started roaring. And I'm looking at the value of my trade, and it stayed pretty much even for much longer than I thought. And it was really weird. And then eventually it got to a point where it did start to become profitable, and Apple moved enough, where that trade did become profitable because the delta changed enough.
To where the put wasn't really losing anything, but you were making more money on the your long 50 shares or whatever.
Right. But the time to expiration was so short that I really thought that position would become profitable, much less of a move than it did.
Some of these trades, when you calculate it all out, takes a pretty aggressive move to where you can start making money.
Huh.
I would think, Epik, on that case, that the volatility increase would affect the price of that put and skew it a little more than what you might think it should be.
Well, if the market was rallying and it went higher, that put probably would decay a lot faster, depending on what day, because a lot of people know as the market trades higher, the premium values come in. It's only when the market is scared that the puts get a bid to them.
Which is why we look at the VIX, for example.
Totally. I think nowadays, because the VIX is just, everybody sells it. Oh, the market went up S&P's up 2 points, and they're selling the piss out of the VIX.
Right.
I really think that the VIX has really lost its true value, because I remember when it used to be in the 30s, and you're like, wow, that was like standard. Anywhere between 18 and 28 was like all. When it got above 30, nowadays it's like, oh my God, the VIX is above 16, and people are like worried to some downside risk.
Yes.
And I mean, seeing the VIX at 12, it's like, makes me want. To me, it becomes a useless indicator.
Right.
So I know as the market's going to go up, premiums are going to shrink. It's not. It's only when the stuff starts getting bid is when people start getting nervous and going, "Oh my God, I need to protect some downside. I need to either be buying puts or selling some upside calls."
So Epik, if I could ask you, would you recommend this trade that I dreamt up here in a half twilight state, or is this like by far a bad strategy and there are better ones to try to get yourself into a position where as long as the stock moves, you're profitable, doesn't matter what direction, and if it doesn't move at all, you only lose a little?
It's an all right strategy because I mean, the banks and so forth, the hedgers, the market makers, that's what they do. We try to put on a delta neutral trade and we hedge our delta risk. And sometimes we'll Texas hedge if we want to lean one way or another. Like let's say I think the market's going up, so I buy that at the money put, but on the underlying, when I buy the stock or I buy the futures, instead of it being 50, I might buy 60. So I'm already net long, and that's called a Texas hedge because it's not.
Right. So my understanding of the reason that say market makers put on delta neutral hedges is that they think the option is mispriced and they think there's an edge there, but they don't want to take a risk on the big move. They just want to capture that little bit of mispricing.
Well, the reason why you put on a delta neutral hedge is because they don't want exposure to the market, and it's easier to handle. Once, because I have to make a market, I might not want those options, but as a market maker, it's my job to make a market. And if you come and lift my offer, I'm going to have to be going in there and buying the underlying.
Right. So my goal here, though, is the opposite, right? I'm not looking to stay neutral. In fact, I want just the opposite. I want to enter neutral, and then I want everything to go crazy and see this position increase in value.
Right. So when you do that, you're going to have to calculate where you really start making money, and do you really think the move's going to be there? Because with Apple, the premiums are high, as they are. So that means you need a much bigger move.
Why, in this case, either Epik or Coder, would you choose to buy some number of shares of stock rather than just using delta hedging on the options alone?
So just buy the stock and you just buy the put and you wait for it to go down and then you hedge as it's going down?
Well,
Coder kind of doesn't know which way it's going.
Coder was saying he would buy some number of shares of stock and buy a put, and it sounds like what you're talking about doing, or a similar thing to do with less money, would be to just buy a put and buy a call. In essence, doing a straddle, right, and then waiting for one of them to move.
So here's why I thought of this instead, is certainly you could buy a straddle. That would be the same kind of idea, that it doesn't matter which way the stock moves, you just need it to move far enough. But I thought that this strategy would require the stock to move less than a straddle, especially if you have high implied volatility. With this strategy, it doesn't seem like it would matter what the implied volatility is, because you're starting out neutral, and if it seems like that just gets canceled out, the implied volatility. But if you buy a straddle and it's expensive, well, now you need your stock to move a lot. Where I thought with this strategy, you wouldn't need, you need your stock to move a certain amount, but less than the cost of a straddle.
You're picking up 1-to-1 on your stock,
right?
And put option isn't going to decay that fast,
right?
Right. That's the whole premise of the trade.
Right. So
I would just take it, just paper trade it longer, and look at longer dated. Don't just look at the short dated.
Epik, I just have one comment which I made, and I will still say that no matter what you do in this strategy, unless you have the ability to short the stock, it does not work.
You are correct, Kumar. That is a real world consideration. If you need the short stock and you can't short
if you
it,
have
you got
no
a problem.
money, you're not going to be putting on this strategy anyways.
That's my frustration. I can't short the damn stock. Otherwise I'll be very happy to do this as kind of thing. It's just the kind of thing I would love to do, but I get stuck every time. Hey, and I can't short the ETF. I mean, for all the things. It's not the stock, it's the ETF.
You don't have to short the stock.
You go the other way.
Yeah.
Go long the stock and buy a put.
Right. So he's not shorting any stock. He's going to sell the stock that he owns. And
he doesn't own any stock. He buys a put and buys the delta. So many deltas in stock.
he's buying the put and he's buying the underlying, and he's doing it delta neutral.
But that's only half the strategy. Think of it the other way around, The
right. If you wanted to do it the opposite way.
Yeah.
Well, the math works the same if you go long the underlying or go short the underlying.
I know you are right. I'm not disagreeing with you. I'm just saying this is my problem. I can't short the thing. That's all.
See,
You're haunted by
one of the key things
shorts.
like that you learn is you always want to be selling. Always be a seller. And that's what option guys do. They want to be sellers of options because I can always go into the open market and buy it if I'm in trouble. So, you always want to be selling, taking in that premium. You sell stock short because it's easier to, hopefully borrow it and just sell it and take in that money and do what you want with it. And
so Epik, I'd like to ask why do you think it was that when I saw that huge move in Apple that the position didn't become profitable soon where it would have so let me restate that. So on other days I paper traded the same strategy and I saw a $3 move in Apple, okay, and it looked like a $3 move was about break even. If there was more than a $3 move, the position would start to become profitable. I saw that on earlier days. And then on this one given day, it moved a lot more than $3. I forget how much, but it was like at least twice that. It was like $6 move or more. But I didn't see the position become profitable until it got up close to about $6. And I'm thinking, well, why didn't it become profitable at $3 like it did these other days where it wasn't news? And I was talking to one person about this, and he said, when there's news, you can't really rely on the Greeks behaving according to their theoretical models. When there's news and everything's crazy,
everything gets skewed. It gets skewed, and you're like looking at your implied, you're looking at historical volatility, and it doesn't match up. And you got to wait till that euphoria calms down, so the pricing mechanism comes all back in the line. Because what was happening is probably as Apple was rallying, as it was going higher, those puts weren't decaying. People were getting nervous. They're like, oh, this is an opportunity because Apple's had to change to where it's more like on a bearish. You want any rally you want to sell. So people who don't want to short the stock or can't borrow it to short have to go in and buy those puts. And as the market was going up, those puts weren't losing any value.
I see. So the puts just weren't losing value fast enough because of the way people were reacting to the news. But eventually that kind of calmed down, and then it did become profitable.
Right, and then where the underlying started to trade out and become comfortable, then the markets maker's going, whoa, these puts look a little bit too high to where this market's trading at. And they'll go ahead and start selling the puts and get everything back into line. But now the computers are supposed to do that.
I see.
But
yeah,
not
that's
on the
interesting.
floor anymore. Going, hey, wait a minute. I got to adjust for this, or I have to readjust my vols to I would calculate the at the monies, and then I would look at everything else, and I'll say, okay, we rallied up. The at the money straddle came in 2 full points. Now where do all my puts are? Where are all my upside calls now? That's how you do it. You always look at your at the monies. So if the stock is trading at, let's say Apple's trading at 300, you're going to look at the at the monies, the calls and the put, and that has a value. Let's say it's 157. Now you look at the next strike. Apple rallies up to $325. So then you look at those calls and puts, and all of a sudden, instead of at 155, you calculated it at 152. Well, I know vol came in $3 full. Now, where it came in it is like, I don't know. Well, we traded up higher. The puts got bid. So, I mean, the calls got bid. So maybe the puts are the ones that are cheaper.
I see. That's interesting. Hey, Epik, can I ask you another question? This is great having you one-to-one. I don't know what your phone number is, so this is great. Why is the volume of options on futures so light?
It depends what commodity you're in. You got to understand, commodity is for the ultra rich, or for very well off people. And the options are the hedgers and stuff like that are using the options on futures. Now, if you ever looked at the Eurodollar options, that's crazy. I mean, because there's huge open interests. There's huge trades that go in there. 10,000 lots is easy. I've seen 40 and 50,000 lots go at one strike for like a call. And you're like, what's Bank of America doing, and what are they hedging? Then all that stuff comes up, and you write a little note on a little piece of paper, because someday they're going to come back and want to get in and out of them or something. Or you go and see if they hedged it in the pit and see if volume went into the hedge side in the futures. But if you ever looked at, it's all computerized now, and so if you go to the Merck website, you can see how big that market is. But when you go into like orange juice is like I want to say the soybean market back in its day. It's a real wild west over there, and it's a small market. Small participants are in it, and therefore there won't be a lot of option action in it either. Just like we used to trade oats at the Chicago Board of Trade, and I would always want to trade options on it, but there was nobody to trade them with.
Yeah, let me just interject for a second, because we were talking earlier about these minis, these new mini things, and actually it's not a new concept to the exchanges, because there already is a mini that's been around since 2005. So I just wanted to show, for example, here's the SPX trading at 1548, and you can get options here. So for example, the 1550 is trading now at on the call side 1970 by 2080. So just remember that for a second. That's the 1550 strike. The original way that they came up with the minis was to actually do a separate symbol. And so that's the XSP, which is seems like the SPY, but has zero volume on it and trades more in line with the purposes for the options itself. And here you can see the 1550 or the 155 is trading at 198 by 209, which is in line with the 1970 by 2080. It's the same concept we were looking at earlier. But take a look at the volume. And this speaks to Coder's question. Nobody's trading it. You have all this open interest, hardly any volume. On the put side, you got a lot of open interest on the downside here, and yet very little volume. There's a lot of volume at the 147 strike, interestingly enough. But here, when they created this concept of minis, they created a separate symbol, and maybe takes a little bit off the radar. I think with this new structure, the fact that they're listing these mini contracts right next to the monthlies and weeklies, having it show up on the same in the software anyway, it's showing up next to it. I think they'll get a little bit more attention and maybe possibly give it a little bit more volume.
Not only that, guys are going to look to arbitrage that. The market makers and the banks are going to look for arbitrage opportunities between the two strikes. The same strikes, but they'll be like, hey, this is off a penny, and let's bring it back in line. Mm-hmm. But I really think, it sounds like a new opportunity, but I go, hey, wait a minute. These 10-lot, these mini contracts, I'm just like, dude, it's just another way for the broker to make money. It's just to get the little guy in there and get burned.
That was my very first thought, and some early commentary I read on it they were saying, "Oh, I wonder if the brokers, they should be lowering their commissions by 1/10." And the first thing I'm thinking is, why would they want to do that?
Right, it's going to be the same thing, and that means it becomes an unprofitable trade for the retail side, and that's what they're trying to bring in.
Right.
Like, all of a sudden now my commissions, I need a lot bigger move to cover the commission, because believe me, an options contract, whether it's a mini or a big, is going to be the same.
Mm-hmm.
You know, so I don't see it that useful. And I'm just like, tell anybody, why trade Apple? Because I know a lot of people who gets burned on that stuff and the options and everything else, and all it is like, oh, I'm using less money, but you're going to lose it.
Yeah.
Unless you paper trade for a long time, watch these markets for years, and do your homework every single day, even when you're not trading, you're not going to make a dime. And when I heard that stuff, I know which 5 they are. There's like Amazon, Google, GLD, the SPYs, and what's the other one? Those are the
Priceline?
5 contracts.
No, it's Apple.
Oh, Apple, yeah. Oh, so it's Apple, Google, Amazon, GLD, and the SPYs.
Right.
And I'm just like, you know what? If you can't afford the big ones, you probably shouldn't be trading those either.
And this is a pilot program. It's I guess Epik, you weren't on at the very beginning of the show.
No, I didn't come until like.
But the intention is to have it for stocks that trade over $100, stocks that have the volatility, and
right. I know about the. I
that's
know
pretty much it. I mean, something like Priceline. As much as people do trade Priceline, I do think that they would consider Amazon to just be able to garner a little bit more attention than Priceline.
Well, they probably also have to look at the open interest and the options to say, okay, look at there's a lot of options
Good
trading
point.
here.
Yep.
Let's go and do the minis too.
Yeah.
Because I'm sure like the market makers and stuff like that, they're going to want to do the arbitrage and stuff like that, and they want to make sure it's going to be liquid too if they're going to put it on.
So let's see. Priceline had 2.7 million options traded today, if I'm reading this right, versus, let's say, Amazon.
Is that the value of the options, or is that all the options? Oh, that's maybe all the options.
Yeah, see, now Amazon's got a lot less options. Of course, you know, it's another factor is if they feel like they already have enough volume on Priceline. Right. Let's try to bump up the volume of the minis here. Maybe they'll bump up the volume. Yeah, see, Apple's got 500,000 options traded today. And let me get back to Priceline. That's really ridiculous. 2.7 million. Can that be true?
Maybe. What's going on? Have they got earnings coming out? Is something going on?
All right. You know what? I don't think the number updated properly.
Didn't update.
Now it says 19,000. That just seems skewed. All right. So
I think our Slim heard us talking, and they're like, "Oh, we better fix that."
Yeah, so that speaks to your point. The Amazons and the Apples we just saw have hundreds of thousands of options getting traded. Priceline has less than 20,000.
Yeah.
So they're going to go to the ones that have the I'm saying volatility, but it's a marketing thing. Where's all the money to be garnered? Where's the cost benefit analysis if we have to create all these other categories and change the software to have this increase of routing and et cetera, et cetera. Let's do it on the ones we're going to make the most money on. And so there'll be this group of 5 until
there's another new 5. Well, they're going to add 5 at a time, but it might be 6 months down the road.
Yeah, and I ran off a handful of possibilities: Visa, MasterCard, even Goldman Sachs, which I don't know if they'd like that, but that could be a possibility. And then you've got the other indices. You could be doing the Qs, you could be doing the
the Dow, whatever. But the Dow, that's
diamonds.
30 stocks, and it probably won't have that much, that much traded on it.
Yeah, but I think it's going to be driven by where they can make the money. And
it is. It's all about making commission. It's why do you think they took all these mortgages, bundled them up, and resold them?
Yeah, because they weren't making enough on the individuals.
The mortgage and collect the interest. That's the whole idea. It's not like taking products and repackaging them and selling them off again. That's the only way banks can make money. That's the reason why instead of them their underlying, a bank's share price should be about $10 if you stick with traditional banking. Should be $10 a share. But all of them are mixed up with all these packaging, mortgages, and everything else, doing derivatives on products and things like that. That creates higher stock prices for them.
Were you talking about Citigroup?
So, well, Citigroup's okay. I'm J.P. Morgan. How about that?
Well, I meant for the reverse stock split idea of Citigroup.
Oh,
You don't have to think of them as a $10 stock.
right.
They're a $40 stock. Or are they?
It's really, they're like only worth what, $2?
Or that's
If
what it was.
you
Yeah.
go back
It's
back
20
it all out.
They're
It's
25
like
now, right?
$2.
Yeah, because they went 10 to 1 reverse or 1 to 10.
Right. No, it's $50 a share. And where is it trading at? 20 something?
No, it's up to 45 now.
Oh, is it?
Yeah, that's what I thought it was. So yeah, it's like $4.50, really in line with Bank of America at only a couple months ago.
Bank of America, I think, is probably the strongest out of all of them.
They're not doing too bad.
I think Bank of America is heading towards 20. So, but let's wait for this pullback.
All right. Well, listen, guys. I know we could do this all night, but I do need to attend to some other things tonight. And short of actually leaving the mic open and you guys talk amongst yourselves, I want to thank you for calling in and being a part of the show tonight.
Well, thanks for having us. And
I think we've started up a conversation on some new things to think about, and that's great. We'll get to
Okay, thanks for having me, Briguy. You guys all have a good night and happy trading.
Thank you.
you
Epik.
too, Epik. Hey, Epik, I appreciate your all your insights.
Oh, thank you. Thanks for calling in, guys. Talk to you later.
Okay, take care. All right. Good night.
Bye-bye. And also thanks to Kumar. I know he came off the line there, but appreciate him being on as well. And of course, Dyla. I think you're still here. If you haven't, I don't know if you just muted your mic or where you went, but now you're gone. All right. So I guess everybody's gone. So that's going to do it for the show. We thank all of our guests for being on the Tools of the Trade. We appreciate it. And furnishings are provided by... No, I don't have a list to give you there. Our guests stay at the beautiful Hollywood... What was the name of that Tonight Show hotel that everybody stayed at? In Burbank, California. All right. So thanks, everybody, for tuning in. And as soon as I can get some time in a couple of days, I'll get this archived for a few of you members who reached out to me ahead of time and said that you weren't going to be able to be on, but you wanted to know about the mini options. So we'll be happy to cover that, get that set up for you guys in the members forum to see that. So if you're talking about tomorrow, you guys can answer for me that will be handled in the upcoming days. So thanks for tuning in to Tools of the Trade. This is Briguy for daytradingradio.com. We appreciate you listening and watching and being a member. And we'll see you in the AM. Good night.